All right. So how Fibonacci's work is straightforward. I mean, some people might find it confusing, but the way I've explained it over the last couple of classes that I taught on Fibonacci's, it's pretty straightforward. So what we usually see, what you would know by now, is that the market does not move in a straight line. Is that the market moves in waves, and what might look random to you like this can actually be mapped out or traced using the Fibonacci tool. So the Fibonacci tool just measures the pullback and gives us the projected extension. So think about it like this. Think about you bouncing a ball, and if you have a level like this, and let's say you throw the ball, you bounce the ball would fall. And picture it like this: if you throw it with plenty force, it will come back up deeper, and then it will only have enough momentum to fall to probably this area here, and vice versa. If the ball was up like this and the ball came back to here and it bounced off, or let's say a tabletop at this level, it will only have enough momentum to go so high. If you raise the tabletop, let's say to somewhere here, and you bounce the ball with the same force, it might have enough momentum to go higher. And similarly, if you lower the tabletop and it comes down to here, it will only have enough momentum to maybe go somewhere here. So if you understand that concept in terms of moving the tabletop, that's how you would now be able to measure the waves. So as the market moves like this, and we come down, and let's say we're here and we have a U-turn. Our job as traders is to say, all right, if we're in an uptrend and all my criteria are met here, I want to buy at this area here. But when I buy, I want to see two things, because every time you place a trade, you need to find three things. Your entry, which for this example, we found an entry here. Your stop. Are you going to be an aggressive trader that puts a stop, let's say, beyond the U-turn? Or are you going to put this stop beyond the previous low to give the market some room? We didn't go over that in detail as yet, but when we deal with the class on stops, we would cover that. And if we find this here, we also are going to need an exit. That's the third thing. So an entry, a stop for protection, and a limit or exit that we say, you know what, I think this market is going to push up to this area here, and that's where I want to take my profit. And the Fibonacci tool is a tool that allows us to do that. So if I have the Fibonacci here like this, and I'm just putting it next to it for now, how the Fibonacci works is this: you start at 0 and you go, just now, let me, right. So if in an uptrend, you'd start at the bottom, and you see this first push here in the market, you put the market from the bottom, the start of the move, to that first high. How the Fibonacci tools work is like this: when the market pulls back down into a level, now this tool again, Smart Trader makes it a lot easier. I had to learn, when I was learning, all of these were like the same color, and we just had to learn, 0.382, 50618 goes to the 1.618, 786 goes to the 127, 86 goes to the 1.18. Now, understanding the concept and the way they did it, it makes it a lot easier, because what you have to understand in terms of the example I described, if the market pushes like this, and let's say your tabletop is here, anywhere between these red, what the Fibonacci tool says is that the market will have enough momentum to come up here to this matching red. So if I enter here, I would look to take profit up at this level here, because after that level, I would expect a major correction. If the market, however, comes deeper, and let's say it comes down to this blue area here, and then we have an entry, we're saying that, you know what, the market would not reach all the way up here. The market would only have enough momentum to come to the 1.27, or blue to blue. And similarly, if we came all the way down to the green, we're saying that the market only has enough momentum to come up to the 1.18, or green goes to green. And that's how you map out your targets based on the information that you have in front of you, and that's how you use the Fibonacci tool. So it measures the waves. So something that looked random before, we can now actually plot and say, you know what, if this was the initial push that we had and the market came back down to here, once we reject here and I have an entry here, the market could push all the way up to this area here. Now, it does not mean that it'll just push up to this area in a straight line, but what you will see happening is you might have the market doing something like this before we have another. You see how this here was a big correction? It will come up to this area and then we would have a bigger correction before we continue again. And how it works, how you map it, just to make sure that you're mapping it properly. When we have the start of the move, we label that A. Right? In an uptrend, the lowest point is A, and your first high is going to be a B. Now, your first high, a high and a low are described like this in terms of the definition. For a high, you need to have two candles to the left lower than it, and two candles to the right lower than it. For a low, you need to have two candles to the left higher than that candle, including the wicks, and two candles to the right higher than that candle. So in an uptrend, you start at the lowest point and you go to your first area here. So let's say this area here is our B. That's where you plot your Fibonacci and you start to measure the waves. And you say, you know what, A, B, if the market comes and U-turns here, and again, all your criteria is met, this area here becomes your C, and your exit is going to be a D extension, which will be based on the C, meaning where the market U-turns in the Fibonacci, that's how you will determine where your target is going to be. So when the market works its way up, and we finally come to this level, and our D is hit, what happens now? What was C becomes a new A. What was D, so where D is, becomes a new B. And you're going to repeat the same thing again until the trend ends. You're going to wait for the market to come back into this area here. When it does come back and it U-turns, that becomes your C. And based on where your C is, you say, you know what, we have enough momentum to come up to this level here. When the market hits that area like that, that becomes your D. And then you repeat. C becomes A. D becomes B. And so on. And that's how you plot your Fibonacci's on these markets. So basically, if you were looking at an uptrend, and this is where we were at the current market, when you're plotting, you would have had two swings already. And by the time you're looking at the market, you're here. So if this is where we're at and we're looking at the market, then what we are doing now, we now say, you know what? This is my new Fibonacci for the current market price. I'm waiting for this market to come down to this area here. Once we have a rejection at a level, whether it be deeper, wherever, I'm going to know where my target is going to be next. And that's what you do. That is how you do your analysis to get to the current price point. And then once you get to the current price point, it's a waiting game. If this is where we were at, we'd be waiting for the market to come down. When it U-turns, we'd plot our levels. All right, in a downtrend would be the opposite, but very similar. So A would be your highest point. B would be your first low. Again, 2 to the left, 2 to the right. You're going to plot your Fibonacci. Wherever the market U-turns, so if the market U-turns, let's say for this one, it U-turns deeper here to the blue, we're going to say, you know what? We are expecting this market to fall down to this blue before we have somewhat of a bigger correction. So A, B, C, this becomes your D. And then if this is where we're at now in current market, C becomes A, D becomes B, and we'd be waiting. So we'll be waiting for a deeper correction for the market to come back deeper and U-turn. And then when it does, we enter. And we know based on where if it U-turns on the red, we expect it to have enough momentum to come all the way down to here. Does that make sense so far? If it does, just type in a Y. Just let me know that you're with me so far. And what we're going to do now is simply go good. Let's go to the market and look. This is gold. This is the daily chart. We're going all the way back to, this is what, September 2022 for this low here of this trend. Right? Now, again, one of the features Smart Trader has is going to be smart fibs. So once I start at the low point, it's going to plot all for me. So again, it's kind of like a cheat code. It makes it easier. But let's go through and see each fib what we had in front of us. This is the low point that we started at. Our first ABCD. Let me see something. There is a... Where is that tool? Label, right. So I want it bigger. A, B. Look at this here, right? And this way you'll start to understand the momentum. The market came all the way down to the green C, right? Nearly came back to the A, which means our D would be the green line. If we project this green line across here, we could see that the market came up here and then had a correction. So yes, it's not going to be accurate or come to the exact price point, but you realize it did not have enough momentum to come all the way up to this D here. So this became your D. And then C became A, D became B, your new C again. Look, the market came down here and U-turn. And look at this here, the market had enough momentum to go a lot higher. Came up to this line here, and then we had another high forming. C becomes A, D becomes B. Again, came down to this area here, red line, so we expected to have enough momentum to go up to that new red line before. And it did exactly that. You see how it comes basically? It's not an exact science, but as I say, it's a very accurate way of measuring these waves. Because if you bought here, you would have said, you know what? This is my C. Look at where this D is. And you would have taken profit up here at this level here. And then the market had a big correction. Whereas, let's say you're not using this and you bought here. Yes, the market could continue going up, but do you want to be, after being in this market, remember this is the daily chart, so you're talking about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38, 39, 40, 41, 42, 43, 44, 47 days. Right? A month and a half, basically, and the market pushed to the target. Now, this works on any time frame, but for the example, I was just using the daily time frame, right? And then after that, after the market reaches a profit and you're not using a tool like this and you're just still in, do you want to wait another 47 days for the market to come back down and you're in less profit? No, you won't want to, right? But that's how the market moves. And again, the Fibonacci would allow you to measure the wave. So what looked random is no longer random. ABC to D, ABC to D, ABC, we buy, we take profit at this level here, we exit. The market works its way down again. You could see the market came down here to the green level. So we'd be taking profit up here. Look at how accurate it is, meaning in terms of the bigger pullbacks. Came up here and then fell. U-turn here, so we expect the market to go up to this area here. The market did exactly that. And you'd be able to measure wave after wave after wave with these Fibonacci's. Again, accurate. The market came up here, fell, came up to this area here. Now this was aggressive, but again, it did reject a little bit. It did not give us a big pullback like normally. Again, as I said, that's what will happen sometimes, because in this example here, the market was just very aggressive. So the market did not correct at all. The bears never took back control, but then the market continued going, and this is where we're currently at. So if the current Fibonacci that we have our current levels A, B, C. From what we have in front of us, the market U-turn at this area here, it means we'd be looking at 38, 36 up here for our profit target for gold. And if that's the case, then it means that you could buy, again, as I said, it's not going to move in a straight line, right? But what you have in front of us, we have what we call a push zone. So what I will do in an example like this, I would basically come here with a rectangle, and I'm going to say, you know what? Purple, let me do this, purple here, and purple here. I want it opaque. Right. And once I have a zone like this, I am saying, you know what? As long as we're in this purple box, meaning heading from our C to our D. So again, let me label most recent A, B, C, D. A, B, C, and D on gold, right? So if this is where we're at, to me, as long as we're in this purple box here, I want to look for buying or bullish opportunities. I'm not interested in selling unless I know it's a short-term move that I'm looking at, but I would know if I'm selling, I am selling against the trade. Yes, I'm Donovan, correct. So when we're looking, we did the analysis all the way to current. So ideally, if we had spotted this around this area here, we would have bought here. Our stop would have been beyond our A, and our target would have been up here at our D extension. Now, again, this would be a swing trade. So if, as we go through more, the analysis is the same, but what will happen is your style of trading would be revealed to you as you practice more and go through more. Meaning, if you're a swing trader has no problem staying in a trade for a while, right? So if you're a swing trader and you buy the market here and you're comfortable leaving this market, if it takes a month and a half, 2 months until it comes up here, and then you make your profit, then you would be considered a swing trader. A scalper, again, same analysis, but a scalper would not want to be in a trade that long, because to them, again, personality-wise, because I will be teaching you the technical side of it. What I cannot teach you is how your personality would react to these markets. Meaning, there's some people that they would gravitate towards scalping because, as I said, they can't be in a trade like that. Some people, when they enter a trade, let's say the trade is overnight, every minute they have to get up and look at it. They can't sleep, they can't function. So for them, staying in a trade a month is going to be hell. Whereas, if you're the type, again, you enter a trade and you could almost forget it, you will check on it ever so often. You're going to check every day, but you're not going to need to check on it every minute. Then you might gravitate towards swing trading. And if you're a day trader, you might not want to stay in a trade as long as a swing trader, but you might be comfortable for a 2-3 days push. Because again, as you could see, if we go down here, even if we expect this market to go all the way up like this, right? Is not moving in a straight line. So a swing trader enters here and would stay all the way up to here. A day trader, you see how the market is basically doing this, higher highs, higher lows, and waving up. Sorry. How the market is doing this, higher highs, higher lows here, and waving up like this. A day trader would be buying these here and maybe staying in for 2-3 days up to this area here. Buying here, staying for 2-3 days up to here. And again, they're going after, they know that the expectation is for the market to go all the way up to this level. So they will be buying the dips and just staying in for 2-3 days, take the profit. So they'll be taking profits along the way. Whereas a scalper would kind of be in and out even more than this on a smaller time frame. All right. But with the analysis that we have in front of us here, let me clear the screen again. Let me just get back to current with smart fibs. Right, so if this is my current analysis on gold, with my fib told me, all right, we should be going from this level here up to this level here. So what I wanted to do is this. I have my purple box identified, and this is the daily chart. I know once we reach up to this area here, I'm going to be looking to exit the trade because I would expect a deeper correction. You see like how the market pulled back deeper here on this side? I'll expect the same thing after we go up here. So for me, again, this is a trade that I took today on gold. So let's now implement or bring in trend lines, right? So if we do our analysis, and this is what we have in front of us, one of the ways that we could enter is this. If I'm bullish on gold, I want to come in with what we call a counter trend line. So when we did trend lines, counter trend line would be in the opposite direction to the trend. So I'm drawing a trend line down, right? And what I'm saying is this. You see how when the market was coming down, it stayed below that trend line. So meaning from here, we came, we bounced. We came, we bounced here. So the market fell once here, twice here. But you see when we finally broke that trend line here, again, just like we did, because trend lines are basically levels as well of support and resistance. So the market was pushed down by this trend line once, twice, and then the third time it broke above. So what happens? What was resistance would potentially become support, pushing this market up. So this area here would have been a good area to buy, which is what I did. I took a buy on gold. The market pushed down to this level, and this is where we're currently at right now. Again, just scoring a point. Scoring a point is basically when the market is waving. If the market does this most recent high here, once we take out that high, the market has scored a point, and we're looking for a correction, and then to go again, continue going again like that. So that was my most recent trade on gold. I bought around this area here, and again, it's resistance that now becomes support with a trend line. So I am expecting this to continue going bullish. So it means until we reach up to 38, 36, I will be looking for bullish setups. I will be looking for this market to continue to push. We're going after, because we know the market scores points, we have a high up here at 35.02 at this most recent high that this market can potentially be going after now. And again, because we measure the waves with Fibonacci's, you could also have what we call sub-fibs, A, B, C to D. And you see, it always aligns. So that's why I always say what looks random is not random. I just explained to you the concept of scoring a point and pulling back. If this area here is a point to be scored, from this sub swing here, you could see that when the market pushes up, because again, it U-turn in the red, so it should have enough momentum to go up to the red. We would score a point. The bulls will take a little rest. The bears will then pull the market down to give us a new A, B, C to D. And that's how we kind of get those waves. As the market would wave up, we'd have a new A, B, C, and then come up to finally here, hit the D line, and then we would have a bigger reversal. Does that make sense? Right? And again, this works on any pair. So that was goal I was on. Let's say I wanted to look at pound JPY or any random pair. Again, once we identify, now pound JPY might be going sideways, right? But let's look at the bigger trend. So the bigger trend is bullish. So yes, we're going sideways right now, most recently. But if we zoom out, we could see that this low here started the trend. Let's see what the fibs are telling us for this. Again, lowest point to the first high, and we could see come back here, push bullish, bigger correction. Come back here again, we had some sideways, but basically still push up, very aggressive. So we didn't have a deep correction here, but we pushed up again. After we pushed up, we had a deeper correction, again red. So that means we expect the market to have enough momentum to go up to red. But before it went up to red, the market came down deeper here to green. And as you could see, it only had enough momentum to go back up to the green before we had a deeper correction. Again, U-turn in red, enough momentum to go up here, very aggressive. Now we're at the most recent point. Now, if we're at the most recent point in this analysis and we're expecting this market to continue bullish, pound JPY is what I was on, right? And if we're expecting this market to continue bullish, it means that based on what we identified, if the market came down here to this green level, it's just shy of the green level, it means that we'd only have enough momentum for the market to come up to, because I'll use that as blue because it didn't quite touch the green, right? To come up to here. So then most recently, again, we could have another purple box here from pound JPY. And the purple box is letting us know that we're in a push zone. So we're pushing from our C to our D. And yes, we have sideways movement, but just like you've seen before, sideways, and then we continue to push in the direction. Right? And based on your question, if you draw a fib correct, the Fibonacci tool helps you determine where your stop should be. So look at this. If this is what we have in front of us here, and the market gave us this most recent A, B, C, and we're looking at buying here, right? And we're expecting this market to push all the way up here. Remember I said 3 areas, right? Entry. If the A is telling you like the deepest part that this market could come before it's wrong, your stop loss should be beyond the A. Because you'd give the market room, even if it comes down a little bit deeper like this. Once it does not take out the A or cross the A, then the market would eventually work its way back up and go after the higher target. So when you buy, in this example here, and you buy pound JPY here at this level, you put your stop beyond here, you could see that the market immediately started pushing in your direction. Yes, we're going sideways right now, but even if we're going sideways, your stop is safe. Maybe because of how much profit you're up, you already move your stop because there's trade management, right? So if the market had pushed like this, your stop is either probably at break even, or maybe you'd have locked in some profits and maybe gotten stopped out already. But you would have made profits, right? But let's say, for the example, we're keeping everything as is. Your target is up at the expected D level. Your stop is beyond the A, and this is this. Because what happens when you have a reversal is the market from here would then finally push down. Let me do this. Would finally push down and take out this level. So the market from here would say, you know what? Take out the A, and you'd realize we start then making lower lows, lower highs. Lower lows, lower highs, and the market will start to go down like this. So then now you reverse your position and you come in with a fib from here to here, and again you'd map out the same waves on the way down. So if you're a Fibonacci trader, that's what you are going to be doing. You're going to be looking for the market to come to these levels. Proper levels that you want to look at, to be very honest, would be 618 and deeper. So in this fib, and let me show you why. Just because of the profit that you have. If this is what we have in front of us, and we already determined that your stop needs to be beyond this level, the highest your target, all right, so let me use it with lines that could move. So the highest your target is going to be is this. Your stop is going to be beyond this A. Then the best entries you could have would be as close as possible to the A, because that would limit your risk, right? So the best entries you could have would be at the 86, 786, 618. These would give you, again, the deeper it comes into the swing, the less risk you have, because you're talking about, when we're calculating the risk now, you're talking about, if we come down here and U-turn, this is your risk. And your reward would be here, if it came down this deep, to come up to here. The 618 and deeper, because the 618 gives you a sweet spot where the 618 tends to give you 1 to 3 time after time after time. So if the market comes like this, pushes down into a level here and U-turn at the 618 level, you're going to enter here. Stop is going to be below the A, and your target is going to be up here, and you're going to go after 1 to 3. If the market comes deeper like this, you actually get like 1 to 4, 1 to 5. If it comes to the 786 in this area here, you enter with a U-turn, stop here, because you might be risking $10 here to go after $45. And on this one here, you might be risking $20 to go after $60. Alright, so that's how you use Fibonacci. Again, as I said, this one is not necessarily a long session, but the Fibonacci is very important when it comes to trading, when it comes to mapping out the waves. So stuff that look random would not be random again. You'd be able to actually kind of measure based on the pullback where you expect the market to go, and you would see, as I showed, it's very accurate. Alright, so for homework for tonight's class, again, go to our chart, and I want you all to pull up or do some analysis in terms of Fibonacci's. Show me where, right? Show me a trade that you would have taken. So if it is, let's say, let me use our whole next pair now. Let's say CAD Swiss franc, and this is what you're looking at. You don't have to zoom all the way out. Let's say, again, just like we started here, I want you to do, first of all, I want you to do manual fibs like this, and I want you to plot them. A, B, C to D, A, B, C, U-turn in red, enough momentum to come all the way down to D, A, B, C, and we're working our way down to red. So like if you see this again, it doesn't have to be plenty, but it needs to be accurate, right? So if this is what you see and you say, you know what, I have A, B, C to D, A, B, C to D. This is our current C, which means I'm expecting the market to come all the way down. Let me actually use a line so it's a bit more accurate. I'm expecting the market to come all the way down to here. And as you could see, if we sold here, you see that the market is working its way down where we're at right now. We're looking like we're working our way down to come after this level. And that's why I use the Fibonacci tools. Alright, so for homework, I want, just like I did here, I want you to identify and label. Now, to label, again, I would have showed you all the tools. So again, from the ABCD, these are smart tools, right? You have the line, and then the third drop down box here, or the fourth drop down box, is going to give you Fibonacci. It's already going to be calculated. So all you have to do is spread it from the area to the area. Just click on the area, spread it like that in a downtrend, and go again. When you have the pullback and you have a correction, you're going to spread it again. And what I want you to map out is you're going to use the labeling tool, which is the 1, 2, 3, 4, 5, 6 drop down box, and it's simply going to go, sorry, 6, which drop down box? Sorry, 1, 2, 3, 4, the fifth drop down box, and it says ABCD label, and you're going to come and just label A, B, C to D, and then you're going to say C becomes A, D becomes B, your new C to D, until you get to current. That's what I need you all to do. C, and you'll have your expected D. So that way when you do your analysis to current, it shows you, all right, if I sold here, this is where the market is going to fall to. This is where I would tell you we're in a push zone. And as long as we stay within this box, I'm expecting this market, based on this chart, to continue to fall until we reach to this D extension down here. Alright, so that's the homework. Pick one pair. Again, you don't have to go all the way back to the beginning of the chart. Just identify an area where you could see 3 or 4 waves, and I want you to plot your Fibonacci's, label them A, B, C, D, A, B, C, D, A, B, C, D until you get to current, and you have a C, and you have an expected D on your charts, and that will be what we will do for homework for tonight's session. Alright, so that's it for the session tonight, guys. Have a good night. Again, this video, by weekend, you all would have the recording for this, and we would go from there again. I sent out the recording again. It was supposed to be shared with everyone before. I shared the playlist. So that link that you have the playlist, when I add this video, you go to the same playlist, you will see an additional video. You'll see the video for Fibonacci's added to the playlist. Alright guys, so that's it for tonight's session. Have a good night.